The world of trading is often perceived as a chaotic realm governed by chance. Yet history is replete with examples of individuals who have mastered its intricacies, transforming it into a science of probability and disciplined execution. Among these luminaries stands Mark Minervini, a name synonymous with exceptional trading prowess and a testament to the power of a systematic approach. Minervini, a self-made multimillionaire stock market wizard, is renowned for achieving triple-digit returns for 5 consecutive years in the 1990s, averaging an astonishing 220% annual return. His deep understanding of market dynamics and unwavering discipline culminated in a truly remarkable feat in 2021 when he clinched victory in the United States Investing Championship, delivering an astounding 334.8% return in just 12 months. This extraordinary achievement was not a stroke of luck or a random outcome. It was the direct result of a precisely defined, single trading pattern that forms the cornerstone of his highly successful methodology. Today, we will meticulously unravel this singular pattern, exploring its core principles, its critical components, and the disciplined application that empowered Mark Minervini to achieve such unparalleled profitability. Our journey will delve into the very essence of his champion year, revealing the actionable insights that you can integrate into your own trading framework. At the heart of Mark Minervini's unparalleled success lies a powerful and remarkably consistent analytical tool known as the Volatility Contraction Pattern, or VCP. This pattern is not merely a visual observation on a chart. It is a profound representation of the underlying supply and demand dynamics within a stock, signaling a crucial shift in market sentiment. The VCP emerges as a stock consolidates after a significant price advance, illustrating a series of progressively tighter price ranges. Each successive contraction signifies a reduction in volatility, indicating that the supply of stock available for sale at higher prices is diminishing. Minervini integrates the volatility contraction pattern as a pivotal element within his broader and highly effective methodology, which he terms specific entry point analysis, or SEPA. The SEPA framework is designed to identify high-probability, low-risk entry points, making the VCP an indispensable component for pinpointing these precise moments. Ultimately, the volatility contraction pattern serves as a visual cue, revealing that a stock is undergoing a period of consolidation, preparing for a potential explosive breakout into a new upward trend. It's a powerful signal that smart money is accumulating shares, and the path of least resistance is about to shift decisively upwards. To truly grasp the power of the volatility contraction pattern and its application within Minervini's strategy, it is essential to understand its key components and how they fit into the broader specific entry point analysis methodology. These components act as a multi-layered filter, ensuring that only the most promising setups are considered for trading. Each element plays a crucial role in confirming the viability of a potential trade, significantly increasing the odds of success. Ignoring any one of these components would be akin to building a house without a proper foundation, compromising the entire structure. Minervini's meticulous approach leaves no stone unturned, creating a robust framework that has consistently delivered outstanding returns. The first critical component is the rigorous process of market stage analysis. Mark Minervini firmly believes that even the best stock cannot perform optimally if the broader market or the sector it belongs to is not in a favorable trend. His methodology emphasizes trading stocks that are already in an established upward trend, specifically focusing on what he terms Stage 2 of a stock's life cycle. Stage 2 is characterized by a sustained period of price appreciation, typically accompanied by increasing volume and improving fundamentals. This phase represents the sweet spot for traders, as the stock is actively being accumulated by institutions and is likely to continue its upward trajectory. Attempting to trade stocks in Stage 1, base building, Stage 3, top forming, or Stage 4, downtrend, significantly increases risk and reduces the probability of significant gains. Minervini's focus on Stage 2 is not arbitrary. It is rooted in the understanding that momentum begets momentum, and buying strength is often more profitable than trying to catch falling knives or anticipate reversals. This disciplined approach ensures that trades are initiated with the wind at their backs, leveraging the power of existing market trends. The second crucial element, intimately linked with stage analysis, is Minervini's meticulously defined trend template. This template comprises a set of objective, quantifiable criteria designed to identify stocks exhibiting the strongest and most desirable technical characteristics. These criteria act as a checklist, ensuring that only the highest quality setups, those most likely to undergo a significant price advance, are considered. The trend template is a testament to Minervini's systematic and data-driven approach, removing subjective bias from the stock selection process. Each criterion serves a specific purpose, contributing to the overall robustness of the pattern. Firstly, the current stock price must be above its 50-day, 150-day, and 200-day simple moving averages. This stacked arrangement of moving averages is a clear indicator of a strong and sustained uptrend, confirming that the stock is performing well over various time frames. It visually demonstrates that short-term momentum is aligned with intermediate and long-term momentum, a powerful sign of institutional accumulation. Secondly, the 200-day simple moving average must be trending upwards for at least 1 month, and ideally for 4 to 5 months. A rising 200-day moving average confirms that the long-term trend is firmly established and moving in the right direction. The longer it has been rising, the more entrenched and reliable the uptrend is considered to be, reducing the likelihood of a false breakout. Thirdly, the 50-day simple moving average must be above both the 150-day and 200-day simple moving averages. This configuration, often referred to as bullish alignment, signifies that short-term price strength is dominating, pushing the stock higher with considerable force. It reinforces the idea that the stock is under aggressive accumulation and is likely to continue its ascent. Fourthly, the 150-day simple moving average must be above the 200-day simple moving average. This criterion further solidifies the intermediate-term trend, indicating that the stock has been showing consistent strength over a more extended period. It acts as another layer of confirmation for the overall health and direction of the stock's price action. Fifthly, the current price of the stock should be at least 30% above its 52-week low. This condition ensures that the stock has already demonstrated significant upward momentum and is not languishing near its lows. It screens out underperforming stocks and focuses on those that have already proven their ability to generate substantial gains. Sixthly, the current price must be within 25% of its 52-week high, with a preference for stocks that are much closer to setting new highs. Stocks near their 52-week highs are showing relative strength and are often poised for significant breakouts into uncharted territory. This indicates strong buyer interest and a lack of overhead supply to impede further price appreciation. Finally, the stock must exhibit a strong relative strength rating. Relative strength, often measured by the IBD relative strength rating, compares a stock's price performance to that of the broader market. A high relative strength rating signifies that the stock is outperforming the majority of other stocks, indicating that it is a market leader and a preferred target for institutional investors. Together, these 7 criteria form a robust filter, ensuring that only the most technically sound and dynamically performing stocks are selected for potential volatility contraction pattern setups. The third crucial component of the volatility contraction pattern is the sequential contraction of volatility and volume. This is where the contraction in VCP truly comes to life, providing a clear visual representation of diminishing supply and increasing demand. As a stock consolidates after a significant price move, it typically undergoes a series of pullbacks or corrections. With each subsequent pullback within the volatility contraction pattern, the amplitude of the price swings, or volatility, should noticeably decrease. This progressive tightening of price ranges indicates that the sellers who were eager to exit their positions have largely been exhausted. The supply of stock hitting the market at lower prices gradually dries up, leading to smaller and smaller price declines. Crucially, this reduction in volatility must be accompanied by a corresponding decrease in trading volume during these contraction phases. Lower volume during pullbacks and consolidations is a critical signal that institutional selling pressure is minimal. It suggests that the smart money is holding onto their positions, and there's no significant distribution occurring. Conversely, when the stock approaches a breakout point, volume should typically expand significantly, confirming strong institutional buying interest as the stock moves higher. A classic example of the volatility contraction pattern in action is the cup with handle pattern. The handle portion of this pattern is essentially a volatility contraction pattern, showcasing a tight consolidation with reduced volume before the eventual breakout. Understanding this interplay between price and volume is paramount for accurately identifying high-probability volatility contraction pattern setups. It tells a story of accumulation, exhaustion of sellers, and preparation for a powerful upward move. Having identified a promising volatility contraction pattern, the next critical step in Minervini's strategy involves the precise determination of entry and exit points. This phase demands discipline and a clear understanding of risk management, ensuring that potential gains are maximized while losses are rigorously minimized. The best setups in the world are useless without a coherent plan for when to enter and, equally important, when to exit a trade. Minervini's approach to these points is systematic, leaving little to chance. He emphasizes that successful trading is not just about finding the right stocks, but about trading them correctly, and that includes managing your capital with surgical precision. For points of entry, Minervini focuses on identifying optimal breakout points from the volatility contraction pattern. The ideal entry occurs when the stock's price breaks out of its consolidation range, pushing above the resistance level of the pattern. This breakout must be accompanied by a significant surge in trading volume, ideally at least 150% of the average daily volume, and often much higher. This powerful increase in volume confirms that institutional money is flowing into the stock, validating the breakout and indicating strong conviction from buyers. A breakout on low volume is often a head fake and should be viewed with skepticism. Minervini advocates for a low-risk entry strategy, where the entry point is close enough to the pattern's support level to allow for a tight stop loss. This ensures that if the breakout fails, the potential loss is minimal, preserving capital for the next opportunity. Sometimes a stock might offer an entry on a retest of the breakout level, providing a second chance for entry if the initial move was too fast. Equally, if not more important than entry, is the disciplined management of risk and the strategic determination of exit points. Mark Minervini is a staunch advocate for aggressive risk control, viewing it as the bedrock of long-term trading success. His philosophy centers on the unwavering principle of establishing a clear, hard stop loss for every single trade initiated. This stop loss is predetermined before entry, typically placed just below a significant support level within the volatility contraction pattern, or below the breakout point. The purpose of a hard stop loss is to immediately cut losses short, preventing small drawdowns from escalating into catastrophic capital impairments. Minervini often targets a maximum loss of 5 to 10% on any given trade, understanding that preserving capital is paramount to staying in the game and being able to participate in future profitable setups. He famously states that the key to making big money is to avoid big losses, and this principle is non-negotiable in his trading operations. Beyond simply cutting losses, Minervini employs a sophisticated approach to managing profitable trades, encapsulated in his no loss or better rule. Once a stock moves favorably and the profit on the trade doubles the initial risk taken, he immediately moves his stop loss to the break-even point or even slightly above it. This strategy ensures that the trade can no longer result in a loss, effectively de-risking the position and allowing the trader to play with house money. It shifts the psychological burden of the trade, enabling the trader to let profits run with greater confidence. This rule is a powerful tool for capital preservation and allows for the capture of substantial gains without the constant fear of giving back profits. For fixing profits, Minervini employs a flexible yet disciplined approach. While he believes in letting winners run, he also recognizes the importance of taking profits at opportune moments, especially during extended runs or when a stock shows signs of topping. He may implement partial sales, selling a portion of his position as the stock makes significant advances, especially after a particularly strong surge. This strategy allows him to lock in some gains while still participating in any further upside potential. Alternatively, he might use trailing stops or sell when the stock breaks below key moving averages or trend lines, signaling a potential shift in momentum. The ultimate goal is to capture the bulk of the move without being greedy, always prioritizing the preservation of accumulated profits. This balanced approach to profit-taking ensures that the gains from successful volatility contraction pattern breakouts are realized, contributing directly to the overall profitability of the trading account. We've dissected the mechanics of Mark Minervini's volatility contraction pattern, from identifying the right market stage to pinpointing precise entry and exit points. However, even the most meticulously crafted strategy remains inert without the bedrock of psychology and unwavering discipline. These intangible qualities are, in fact, the very foundation upon which all successful trading careers are built, and Minervini himself emphasizes their paramount importance. The human element, with its inherent biases and emotional responses, often presents the greatest challenge to consistent profitability. Without a robust mental framework, even a flawless system can crumble under the pressure of market fluctuations. Minervini consistently reinforces that his rules are not suggestions but strict directives to be followed without deviation. The disciplined adherence to rules is non-negotiable in Minervini's methodology. He understands that markets are designed to prey on human emotions: fear, greed, hope, and regret. These emotions, if unchecked, can lead to impulsive decisions, deviations from the trading plan, and ultimately, significant losses. By strictly following his predefined rules for stock selection, entry, stop-loss placement, and profit-taking, Minervini removes the emotional component from his decision-making process. This robotic adherence to the system ensures consistency and prevents self-sabotage. It's about building habits that serve your long-term financial goals, rather than succumbing to short-term emotional impulses. This level of discipline is not innate. It is cultivated through conscious effort, practice, and a deep understanding of one's own psychological tendencies. A cornerstone of Minervini's psychological approach is the resolute cutting of losses. This is perhaps the most difficult rule for many traders to internalize, as it goes against our natural inclination to avoid admitting mistakes. Yet, Minervini is unequivocal. The number one key to making big money in the stock market is to not lose big money. He emphasizes the importance of quickly closing losing positions, often within a tight, predetermined risk tolerance. This isn't about being right on every trade. It's about being right when it counts, and minimizing the damage when you're wrong. Small, manageable losses are merely the cost of doing business in the markets, and they preserve capital for the next potentially highly profitable opportunity. Hesitation, hope, and the desire to be proven right are the enemies of this principle, leading traders to hold on to losing positions, allowing them to spiral out of control. Conversely, Minervini champions the principle of allowing profits to grow, a concept often summarized as letting your winners run. While cutting losses swiftly is crucial, equally important is the patience and conviction to hold on to winning positions that continue to demonstrate strength. Many traders make the mistake of taking small profits too quickly, only to watch their stocks skyrocket after they've exited. Minervini understands that truly significant gains are generated by riding large trends. He employs techniques like moving stop losses to break even, or using trailing stops to protect gains while giving the stock ample room to continue its upward trajectory. The ability to endure minor corrections within an uptrend without being shaken out of a profitable position is a hallmark of his disciplined approach. It is the large wins that ultimately compensate for the numerous small losses, creating the asymmetric risk-reward profile essential for superior performance. The final psychological attribute that underpins Minervini's success is patience. The market does not offer high-quality volatility contraction pattern setups every day, or even every week. Attempting to force trades when conditions are not ideal is a recipe for mediocrity and losses. Patience involves waiting for the perfect confluence of factors. A strong market, a leading stock in stage 2, a well-formed volatility contraction pattern with contracting volatility and volume, and a high-volume breakout. This waiting game requires significant emotional fortitude, resisting the urge to constantly be in the market. Minervini selectively engages, conserving his capital and mental energy for those A-plus setups that offer the highest probability of success. He views himself as a sniper, waiting for the perfect shot, rather than a machine gunner indiscriminately firing at everything. This strategic patience ensures that capital is deployed only when the odds are stacked heavily in his favor, a critical factor in achieving extraordinary returns. The principles we've discussed, stage analysis, the trend template, volatility contraction pattern, precise entries, rigorous risk management, and unwavering discipline, are not theoretical constructs. They are the exact methodologies that Mark Minervini meticulously applied during his championship year in 2021, leading to his staggering 334.8% return. His success was a direct manifestation of consistently executing this single trading pattern under a variety of market conditions, demonstrating its robustness and adaptability. The 2021 market presented numerous opportunities for volatility contraction pattern setups, and Minervini, with his keen eye and disciplined approach, capitalized on them repeatedly. Consider the landscape of 2021, a market recovering from the pandemic lows, characterized by strong growth in certain sectors and ample liquidity. This environment created fertile ground for stocks to enter. Stage 2 uptrends, form volatility contraction patterns, and then break out to new highs. Minervini's systematic process allowed him to identify these emerging leaders early, before they became mainstream darlings. He wasn't chasing news or reacting to hype. He was methodically scanning for stocks that met his stringent technical criteria, signaling institutional accumulation and imminent price acceleration. The 334.8% return was not achieved through one or two lucky trades, but through a series of well-executed, high-probability trades, each adhering to the volatility contraction pattern framework. For instance, while we won't dive into exhaustive chart analysis here, some of the stocks that contributed to his impressive performance in 2021 exhibited classic volatility contraction pattern characteristics. Companies like NNOX, NanoX Imaging Lati, and HSKA, Heska Corporation, were among the names that, at various points, displayed the tight consolidations, contracting volatility, and volume dynamics that Minervini seeks. These weren't random picks, they were stocks that had already established strong uptrends, stage 2, met his rigorous trend template criteria, and then formed the precise volatility contraction pattern base before a powerful breakout. His ability to identify these setups, enter with low risk, manage them with tight stop losses, and then allow the winners to run, was the engine behind his championship performance. It was a masterclass in pattern recognition combined with disciplined execution, proving that a repeatable, systematic approach can indeed yield extraordinary results in the stock market. The intricacies of the financial markets have always captivated the human imagination, often leading to stories of immense wealth gained and lost. For those who seek to understand the historical forces that have shaped Wall Street, from its nascent beginnings to its most tumultuous crises, and to learn about the titans who built and sometimes broke its foundations, there is a truly invaluable resource. We highly recommend exploring the Wall Street Memoirs YouTube channel. This channel offers a captivating journey through financial history, providing deep insights into the legendary figures, pivotal events, and monumental financial crises that have defined Wall Street. It's an essential companion for anyone looking to contextualize current market dynamics within a rich historical tapestry. Understanding the past can offer profound lessons for navigating the present and preparing for the future. Don't miss out on this incredible educational opportunity. Head over to YouTube and search for Wall Street Memoirs, or find the link in the description below this video to subscribe and immerse yourself in the fascinating history of finance. In essence, Mark Minervini's championship year, with its astonishing 334.8% return, was not an enigma but a clear demonstration of a finely tuned, systematic process built around a singular, powerful concept. The volatility contraction pattern, meticulously integrated into his broader specific entry point analysis methodology and underpinned by an unwavering commitment to psychological discipline and stringent risk management, is the single trading pattern that unlocked this extraordinary profitability. It is a testament to the idea that success in the stock market is not about discovering arcane secrets, but about mastering fundamental principles and executing them with relentless consistency. Minervini's approach provides a clear roadmap, demonstrating that by focusing on market leaders in established uptrends, identifying periods of volatility contraction, entering at precise low-risk points, and rigorously managing capital, traders can significantly elevate their performance. His journey from humble beginnings to a multi-millionaire trading legend serves as a powerful inspiration, proving that with the right methodology and an ironclad mindset, exceptional results are not only possible but repeatable. The volatility contraction pattern, when combined with stage analysis, the trend template, precise entry and exit strategies, and an unshakable psychological framework, forms a comprehensive and potent system. It allows traders to identify opportunities where institutional money is accumulating, signaling impending significant price moves. This isn't about guesswork. It's about reading the market signals and acting decisively. The 334.8% return wasn't achieved by chance. It was the culmination of thousands of hours of study, meticulous backtesting, and the disciplined application of these principles in real-time market conditions. It underscores the profound impact that a well-defined, repeatable pattern can have when executed with precision and unwavering commitment. To aspiring traders and seasoned investors alike, the lessons from Mark Minervini's championship year are invaluable. They underscore the importance of continuous learning, the courage to cut losses quickly, the patience to let profits run, and above all, the discipline to stick to a proven strategy. The volatility contraction pattern is more than just a chart formation. It is a reflection of market psychology and the supply-demand dynamics that drive price action. By understanding and applying this pattern, traders can develop a more objective and systematic approach to the markets, moving away from emotional decision-making and towards a data-driven framework. The journey to becoming a consistently profitable trader is challenging, but with the right tools and mindset, success is within reach. We hope this deep dive into Mark Minervini's single trading pattern has provided you with actionable insights and inspiration. The principles discussed are universal and can be applied across various market conditions, making them a timeless asset for any serious trader. Remember, consistency and discipline are your greatest allies in the pursuit of trading excellence. Start incorporating these ideas into your own analysis, practice identifying volatility contraction patterns, and develop the discipline to follow through on your trading plan. Your journey towards more consistent and profitable trading starts now. Take the time to study, to practice, and to refine your approach. The market rewards those who are prepared and disciplined. For those who are truly committed to mastering the art of trading and understanding the timeless principles of market speculation, we have a profound recommendation that transcends generations. We urge you to acquire the newly released edition of Reminiscences of a Stock Operator by Edwin Lefebvre. This isn't just another book. It is the definitive classic that delves deep into the mind and strategies of one of the greatest traders of all time, Jesse Livermore. This new edition is particularly special, as it is thoughtfully enhanced with unique commentaries and detailed breakdowns for each chapter. These invaluable additions transform Livermore's historical experiences and insights into practical, actionable lessons directly applicable to modern traders. You will gain an unparalleled understanding of market psychology, risk management, and the cyclical nature of speculation, all through the lens of a trading legend. This book is an indispensable guide, offering wisdom that remains as relevant today as it was a century ago. Do not miss this opportunity to absorb the distilled wisdom of a trading master. Find the link to purchase this essential new edition of Reminiscences of a Stock Operator in the description below, and elevate your trading knowledge to an entirely new level.